I'm in my crypto zone. I'm in my crypto zone.
What's up, guys? Today we're back with a tutorial video. This time we're looking at the 5 most important patterns to identify when trading the crypto market. These patterns are known to have the best success rate when identified and traded accordingly. For those of you that use X, formerly known as Twitter, be sure to drop me a follow at Wagmisaurus. We've just passed 150,000 followers. I upload daily free crypto content, teach fundamentals, and post live trades. Unlike others in the scene, everything I do is free, with the sole purpose to help you advance in trading and achieve financial freedom. Before we get into looking at patterns, we need to understand some fundamental terminology when trading crypto. There are 2 types of trade that you can take. The first is known as a long. That is where you buy with the hopes of the coin to rise in price, in which you will make a profit. The second type of trade is known as a short, where you will sell the token without actually owning it in the hopes of the token falling in price, in which you will also make a profit. When taking a short trade, it's important to be aware that there will be a liquidation price in which if the price of the token touches, you will be liquidated and lose all of the money you leveraged in the position. Depending on the pattern we can identify when looking at a crypto chart, we can decide whether the best option is to long or short the market. So let's take a look at 5 of the most important trends that you will need to be able to identify to trade the market in any condition, whether bullish or bearish. The first pattern we are going to look at is a head and shoulders, which is a bearish formation, and it can be used to indicate when to short the token in the hopes that the price will fall. A head and shoulders can be identified by 3 successive peaks. The middle is the highest, referred to as the head, and the 2 outside are lower and relatively equal in height. These are the shoulders. The head and shoulders pattern is believed to be one of the most reliable trend reversal patterns. When trading a head and shoulders formation, wait for the pattern to complete and the price to move lower than the neckline after the peak of the right shoulder. The most common entry point is when a breakout occurs and the neckline is broken. The reverse of a head and shoulders is known as an inverse head and shoulder formation, which is a bullish formation and often used as a signal to long the market in the hope that the token will go up in price. An inverse head and shoulders can be identified by 3 successive peaks. The middle would be the lowest, which we refer to as the head, and the 2 outside shoulders are usually higher and relatively equal in height. It forms after a downtrend and often signals an upcoming trend reversal from bearish to bullish. The next pattern formations we are going to analyze are ascending and descending channels. These can be both bullish or bearish, depending on the direction of the channel. Channels can be identified when price is trading in a range between diagonal parallel lines. It forms when an up or downtrend is formed between parallel support and resistance lines and suggests either a possible reversal in the trend or a change in the slope of the current trend. When buying a descending channel, we look to buy at support and hold until the breakout. When analyzing an ascending channel, we would look for peak resistance as a point for a sell or an opportunity to short the token. Triangle patterns are important to identify in crypto as they can be a great indicator of future moves and a strong indicator of trend. An ascending triangle can be identified by 2 or more equal highs forming a horizontal line at the top alongside 2 or more lows forming an ascending line that meet the horizontal line. These are generally higher lows, and this will typically form during an uptrend. A breakout usually follows the direction of the prevailing trend. You can look to buy on support of a higher low, or you can enter a position when the price action breaks above the triangle's upper boundary. With increased volume at this point, the price is expected to rise by an amount equal to the triangle's widest section. A descending triangle can be identified by 2 or more equal lows forming a horizontal line at the bottom, otherwise known as support, with 2 or more declining peaks with lower highs forming a descending line that meet the horizontal line. It typically forms during a downtrend, which is bearish. A breakout usually occurs in the direction of the existing trend. You can look to start a short position on the second lower high, or you can take a position once the price action breaks through the bottom trend line of the triangle. A falling wedge can be identified by two converging lines slanting downwards. It usually forms after a downtrend and suggests a bullish reversal in the original downtrend. However, it can also appear in an uptrend, in which case indicates a likely continuation of that trend. Either way, a falling wedge typically results in a bullish breakout. Falling wedge tends to be a more reliable indicator than a rising wedge. When trading a falling wedge, look for the price breaking the upper trend line. Emerging patterns could be traded by swing traders between the convergence lines. However, most traders should wait for a complete pattern with a breakout and then place a buy order. A rising wedge can be identified by two converging lines slanting upwards. It usually forms after an uptrend, but can also occur during a downtrend. There's usually a decline in volume as the price rises through the pattern. A rising wedge typically results in a breakdown, which is bearish. When trading a rising wedge, look for emerging patterns before a breakout occurs. These can be traded by swing traders between the convergence lines. However, most traders should wait for a complete pattern with a breakdown and then place a short sell order. A double bottom formation can be identified by two consecutively rough equal lows with a moderate peak in between, resembling a W shape. This powerful sharp pattern occurs after an extended downtrend and often represents a reversal pattern that indicates a minor, if not long-term change from a downtrend to an uptrend. A spike in volume often occurs during the two upward price movements in the pattern. These spikes in volume are a strong indication of upward price pressure and help to confirm a successful double bottom pattern. A double top can be identified by two consecutively roughly equal peaks with a moderate high in between, resembling an M shape. This is a powerful chart pattern and occurs after an extended uptrend and often represents a reversal pattern that indicates a minor, if not long-term change from an uptrend to a downtrend. This is bearish. Those were the 5 most important patterns to look for when identifying trends in crypto and trading the market. If you can successfully identify these patterns, you will gain an edge when trading during any conditions. Thanks for watching, guys. Don't forget to like and subscribe to the channel if you enjoy this type of content. We upload regular content including technical analysis, fundamental analysis, tutorials, trading advice, latest news, and much more.
I'm in my crypto zone. I'm in my crypto zone.